Recently, Wall Street has been quick to write off Salesforce, the CRM giant, citing slowing growth and the looming threat of AI. But as elite investors, we know that maximum pessimism often creates maximum opportunity. Welcome back to Moneyjourney. Today, we are doing a complete no-nonsense deep dive into Salesforce. We are going to rip apart their fundamentals, break down their sticky business model, and confront the AI threat head-on. Then we'll run CRM through our proprietary Quality Scorecard and execute a rigorous valuation analysis to reveal its true intrinsic value. You won't want to invest a single dollar in tech until you see this data. If you are serious about finding market-beating stocks, make sure to hit that subscribe button to join the Moneyjourney community right now. Let's get into it. Let's open our Moneyjourney stock analyzing at CRM ticker, and in seconds we have it loaded automatically. So if you want to have access to this Google Sheets template, you have the link on the description and on the pinned comment. So looking at the fundamentals, Salesforce is trading at the forward P of 11.9, around 12, which means earnings yield of 8.4%. Right now it's trading at the price to free cash flow of 10.3, which is 9.6 free cash flow yield, which is, it looks very attractive in terms of fundamentals. Their margins are really good, 77.6% gross margins, net margins around 18.7, but their free cash flow margins are higher. In terms of balance sheet, there are plenty of long-term debt right now, 39 billions, but they have almost $12 billion in cash. So returns on equity very high, but their return on invested capital is very low for a software company, only around 7%, and we'll deep dive into that. They only need 3.4 years to pay their debt based on the free cash flow they have in the last year, so that's a very solid balance sheet. They pay a small dividend, less than 1%, but they do plenty of buybacks, around 1.68, but that's just to offset the dilution from stock-based compensation. Revenues very stable, going up each and every year. Earnings as well as net income and free cash flow. Their free cash flow are much higher than net income, which is common in software business that are growing, because they receive the payments from their clients annualized. For example, they pay for the whole year for the next 3 years, and they divide that, for example, by month or quarter. So even though they received $4 billion for the whole year, they added only 1 billion for their net income for that quarter, for example. So that's why free cash flow is much higher, because they are receiving the money from their clients in advance. So as long as they are growing, their free cash flow margin, they should be higher. One thing I like is their stock-based compensation. Compared to net income and free cash flow, it's getting less percentage of that, so that's good news. In terms of revenue growth, they are decelerating. So they used to grow mid-teens, now they are growing around 7% per year, or they are expecting to grow around that. So that's one of the reasons that Salesforce multiples have been decreasing. But when you look into net income per share and free cash flow per share, very linear, going up each and every year, which is very good. Margins going up, trending is going high. Right now it looks like their net income and free cash flow margins are stabilizing. Free cash flow margin around 34%, but net income only 18%, due to what I have explaining, because they receive the money of annually next year in advance. So free cash flow is higher than net income. As long as they are growing, it will be like that. So very good and healthy margins. Shares outstanding going down, even though they have plenty of stock-based compensation. They are doing buybacks much higher than that, so that's good news, as long as they are buying cheap shares. Right now, we will look into valuation, but it looks like a great time to be doing buybacks if you believe in their business. Return on invested capital is low. We prefer to invest at higher rates. So compared to other software business, other companies, return on invested capital is not very good. The reason of that it's because they have been acquiring a lot of companies, paying higher price, even though they have been growing, and growing organically. Their acquisitions and the money they are investing are not seeing good results or high returns. So that's bad. So it's a bad sign for Salesforce. To understand Salesforce's actual value, we have to look at how they make their money. Salesforce operates a classic software as a service or SaaS business model. They are the undeniable kings of customer relationship management, bringing sales, marketing, and customer service into one unified cloud, the Customer 360 platform. They rely on recurring subscription revenue based on the number of seats or users a company needs. This brings us to their massive competitive advantage: extremely high switching costs. Once a Fortune 500 company integrates its entire sales workflow, customer data, and third-party apps into Salesforce, ripping it out to use a competitor is a logistical nightmare. That ecosystem stickiness is a legendary economic moat. But there is an elephant in the room: the AI threat. Wall Street is terrified that AI agents become more capable. Company won't need as many human sales reps or customer service agents. If fewer humans are working, fewer Salesforce licenses are needed, threatening their core seat-based pricing model. However, the flip side is that Salesforce is embedding its own AI, Einstein Copilot, directly into the platform. The question we have to answer is, will AI destroy Salesforce user base, or will they successfully monetize AI add-on and charge a massive premium to the users who remain? The answer to that question dictates everything. In my opinion, license will get reduced, but Salesforce can use other systems to make their clients to pay more. For example, tokens. They could charge based on users and not by license. And will AI can destroy? Maybe. I believe their margin could be it in the future, or their business model will rely on lower margin because of competition. Definitely. Right now, the biggest threat to Salesforce is not AI, or at least not AI directly. What AI can enable is lower software costs, so that could bring other companies to compete in the customer relationship management. For example, other big companies like ServiceNow can invest their resource to make their own CRM platform and then compete with Salesforce. That could be a possibility, in my opinion. With higher competition enabled by lower software costs due to AI advancements, could make pressure on Salesforce margin. So Salesforce will have more competition, so they will have to compete, and that will take a hit on their margin, definitely. So that is my bear case for Salesforce. Now that you already looked into the fundamentals, graphics, and know about their business model, let's do our quality scorecard and evaluate Salesforce as a company. So first pillar, revenue growth. Yes, they've been growing revenue around 8%. In terms of market potentials, analysts are expecting them to grow EPS around 12 to 13%, which is very good. Actually, that will happen. I have some doubts. I don't know how Salesforce will do in the future. There are plenty of AI threats, a lot of bear cases, but if that comes into mind, Salesforce will have a great future if they grow mid-teens EPS. So in terms of quality of their revenues, they are subscription based, so high quality. For now, their business model is great, so it will maintain. You could question it will remain in the near future due to all these threats. that's a question mark. But for now, they are very high quality revenues, so very stable revenues. In terms of product and process development, yes, they are investing a lot in R&D and new product, investing in AI, trying to adapt their platform with AI enable. In terms of margin, very high margins, are almost 30% average. In the last few years, they are free cash flow margin around 34% right now, but the average free cash flow in the last 5 years was around 30%, which is really high margin. 76.3 5-year average gross margin, so very high. Are they maintaining profit margins? Yes, it will continue in the future. That's a question mark. Right now they are pretty stable. Gross margins around 76 to 80%. Free cash flow margins around 34% in the last 2 years. So they are not expanding anymore. They are getting mature, stable. If they can sustain that margins, it will be very difficult for Salesforce in the future. But for now, they've been maintaining. They have better margins than competition. Pricing power, yes and no. For now, they have plenty of pricing power. But if they start to face competition in this area, it will get very difficult, especially if it comes from other big IT companies like ServiceNow that I've mentioned previously, because they already have plenty of clients. Basically, the Salesforce clients are ServiceNow clients, so they could change it easily if they decide to compete with each other in their sectors. So for now, they have pricing power. I would say yes, but a lot of these assumptions could be no in the future. So for now, it's average. They have plenty of that, but this is a very secure balance sheet. Rates of return are bad. Management, I don't like very much. They have been doing a very good job, in my opinion, growing the company, especially organic. But in terms of acquisitions, that's a bad track record because they are paying higher price for that. But overall, the company is very great. So I would say management is competent. The culture there, it's good. In terms of moat, high switching costs, wide moat. I don't like to attribute wide moats to software companies, because even though they have high switching costs, and I do not believe you will see competition from companies developing their own CRM software in their garage. For big companies, if they have a software that fails, that's money loss, and they could not have that risk. So they will continue to use CRM software. So I'll not say that's wide, even though the cost of creating software is getting lower, but it's not a narrow moat. I would say sustainable and enduring right now. It's not widening, it's not getting better, in my opinion, but it's a very good. It could be between a sustainable or a wide moat. I'll say sustainable for now. Free cash flow per share has been growing a lot in the last years, and they have been returning capital, doing buyback, even though most of the money they spend doing buybacks is to offset stock-based compensation. Nevertheless, they are returning capital to the shareholders. So we come with a 72.2 quality score, not one of the best qualities or one of the widest moats out there, in my opinion. I really believe software is getting hit by this AI threat, but it's overdone, because I'll not believe this AI threat will be. Of course, it will make some companies go out of business, but not for the best ones. But Salesforce could face plenty of competition since the price of making software is getting lower. So this could be a bear case, but for now they are the leader and one of the best software companies out there. In terms of fundamentals, incredible. Is it cheap? Yes. Is it a good business? Yes. In terms of returns for the future, growth from revenues and earnings, check mark. P expansion, definitely. Buybacks and dividends, yes, that's the time where they should use their money to increase their buybacks, for example. So in terms of valuation, stock-based compensation, one of the best thing of this Moneyjourney stock analyze, and that's especially important in Salesforce, is that we take into consideration stock-based compensation into our valuation. Salesforce, it was a company that has plenty of stock-based compensation. If you divide their net income by stock-based compensation, it was a major part of that. Now stock-based compensation is getting stable. They are not doing very much. In the last few years it averaged around 3%, and I believe their stock-based compensation could maintain around 2% growth. We should mean a stock-based compensation of $4 billion. Today's is $3.5 billion. So this operating leverage where they can increase their net income, free cash flow, and maintain the stock-based compensation will increase the cash flows of the company. So I believe they could, I expect them to grow around 2% in the next few years in terms of stock-based compensation. It is a US company. In terms of business risk, low or medium. It will affect our discount rate. I would say it's low because their balance sheet is pretty stable. They have some kind of moat, a very sustainable moat, and for now their fundamentals remain intact, so I would say business risk is low. But if they could start to face a lot of competition, especially because they are a software company, this business risk could be a medium. So I will use a 12.45 discount rate for our base case. So in terms of growth rate, they have been growing around 8%, and I believe in terms of revenues they will grow around 7 to 8%. They are expecting to grow 7.6% 2026. So I'll expect them to grow around 7%. Free cash flow margin, I do not believe this 34% free cash flow margins could be sustained if their growth slows, and maybe with competition that could be a problem. I will assume 30 to 32. I'll be conservative at 30%. In terms of PE, what should be the PE of this company? If their software modes remain intact, it could deserve a 20 PE for in the future, but I'll try to be conservative. I don't want to assess 20 PE, maybe 16 or 18, because these software stocks, their modes are getting less wider, I'll say like that, so maybe eroding. For me it will be a 16 or 18 PE for my base case. So I believe that because of the risks, plenty of uncertainty in the Salesforce, I cannot assume a higher PE for Salesforce. Bear in mind, Salesforce is trading at a lower forward PE than 18. Right now it's trading at a forward PE of around 12, so it's very, very low. So you could see some margin expansion. So with these assumptions, I came with an intrinsic value for Salesforce of around $215. So this means at the price that we have right now, $185, you should expect a 15% expected annual return. So the price looks very attractive. Fundamentals are incredible. The return on invested capital, which is a metric that's very important, it's not one of the best, and it's important to understand why. And Salesforce could face plenty of competition, both from AI or other competitors in the future. So that's my bear case. For now, I would like to invest in software. I'm investing in software, but I prefer companies where I believe their moat is wider and it's way more difficult to compete with them. In terms of competition, I believe other players could compete with Salesforce, even though there are plenty of high switching costs. I do not believe clients will leave Salesforce, but for the future, for new clients, maybe other new clients could use other softwares. I don't know. So for me, it's in the too hard pile. difficult to predict their future. But if you believe Salesforce, it's incredible company, and if you remain bullish in the future, this is a great price to buy Salesforce, definitely. So, what is the bottom line on Salesforce? Despite the scary news cycles and the short-term uncertainty surrounding AI disruption, we are looking at an incredible underlying business with elite, cash-gushing fundamentals. Yes, there is a lot of noise right now, but our valuation analysis screams that investors are currently expecting very little from Salesforce going forward. When expectations hit the floor, value investors should pay close attention. I want to hear from you. Do you think AI is the end of Salesforce, or is this the best buying opportunity we have seen in years in Salesforce? Let me know your thesis in the comments down below. If you found this deep dive valuable, please subscribe to Moneyjourney so you never miss our next stock analysis. See you in the next video.